Ally Financial is a stock with a dividend of about 4% and a PE ratio of about 6. Warren bought this company at an even higher price. He owns about 9% of it. He can buy more because there are regulations, which can affect Berkshire. If you look at his filings, you'll notice that he sold a little, to avoid going over 10% ownership. If you analyze this company, you'll find out that there are several opportunities that can make the stock price go up a lot. Plus, you get a nice dividend. And in this stock analysis, I'll help you see their business model, their fundamentals, what opportunities they have, their risks, and at the end you'll find out the fair value of Ally. There are many great businesses out there, but only a few are great investments. My goal is to find those investments where I can double my money in the next 3 to 5 years. So let's see if Ally can be such an investment. Let's begin. Ally Financial, as the name suggests, is a US financial company that offers banking services, and their business model is like this. They operate as a digital banking company, so they don't have physical locations. You can use their app or website. I don't know if you have an overview of how a bank works, but I'll tell you short. You deposit your money at Ally, you might get a yield of about 3% depending on your contract, and Ally takes your money and lends it to other people, charging a higher yield of about 10% or even more, depending on the type of loan. Now, you might say this is unfair for you, but Ally takes the risk. If the borrowers default, they take the losses, but you get your money back safe, regardless of what happens to their loans. If the bank goes bankrupt, you are still protected by the FDIC, which requires banks to have multiple layers of protection, and banks must follow different rules to avoid the risk of going bankrupt. So this is what they do. It sounds quite simple, but there is a lot of bureaucracy behind their operations. Ally focuses more on auto loans, but also offers mortgages, personal loans, credit cards, and an investment platform where people can invest in stocks without commissions. So they provide a digital platform where you can find everything you need related to financial services. You can see in this image where the revenue comes from. Auto finance represents more than 65% of their total revenue, followed by insurance, mortgage, corporate, where they offer loans to businesses, and the last one is corporate and other, where there is Ally Invest, Ally Credit Cards, and other banking services. Now the most important thing is their assets, because they make money from the loans they have originated. You can have a better overview of their business and see the risk in this image better. So it's about the same as the segments, only for corporate and other it's a difference, because that's where their funds come from, I mean the deposits they get from their clients. Now let's see their fundamentals. Ally makes money from the loans they have on their balance sheet and other commissions. You can see their earnings in this image, and their book value, which is total assets minus total liabilities. If you look into the past, you can see that the earnings have grown from about 800 million to more than 1.7 billion. They also had some losses, but they recovered. You see a big jump in earnings in 2021 because of that pandemic that accelerated the transition to the digital economy. And as Ally is a digital bank, they've gained a lot due to that transition. Now, as interest rates have increased, their earnings have declined by more than 40%. They also took on more debt, and that's why you see a decrease in their book value, which makes the price to tangible book value lower. What happens next depends on the economy, especially interest rates. They expect a decline in 2023 and then a rebound next year. Total assets are about 191.8 billion, of which cash is around 5.5 billion. Total liabilities are about 178.9 billion, of which debt is around 20.1 billion. Compared to their earnings, debt is high, but banks generally have high debt. They had even more debt in the past, but because of regulations, they are required to have more layers of protection to avoid the same disaster of 2008. Now let's see what the opportunities and risks are. As you can see in this image, most of their funds come from deposits. The more people they can attract to their bank, the more loans they can offer, and the more money they can make. You can see their customer growth performance in this image. They have about 11 million customers in total, of which 4 million are from Ally Bank, and 7 million from auto and insurance. Most of the growth came from Ally Bank. You can see their loans in this image, where auto is the biggest part, and they started expanding the other loans related to credit cards, home, and other types of loan. They've originated about 43 billion worth of loans in 2022. If you look at the total value of auto loans originated in the US, you will see that for 2021 it was more than 700 billion. And this is only for auto lending. This is about 4% market share. Moreover, the management said that they'll expand into credit card lending. They've already made an acquisition, and if you look at the total credit card balance, you can see that it's almost 1 trillion. And Ally has less than 1% market share in this industry. They have about 0.4%, so there is a lot of room to grow. In addition, there is the mortgage industry, where originations are over 2 trillion a year. And the total mortgage portfolio their assets are about 20 billion. So again, another opportunity for them. The point is, they have a lot of room to grow. They only have to focus on the risk first, not to give out too many loans and have people default on them. If they can do that safely, they'll grow. Now let's see the risks. The first risk is interest rates. As you can see this image, rates keep going up. You might say that banks will make more money, but people will take out fewer loans and might default on their debt. Now, as Ally has most of their loans in the auto lending industry, the risk is not as high as mortgages. You can see in this image the history of defaults on different types of loans. You may notice that auto lending is not as volatile as the other loans when interest rates go up. So the risk will be on the demand side. If the economy contracts, people will spend less money, buy less cars, and Ally will make less money. Another risk you should be aware of is regulations. You can see in this image all the institutions Ally has to report to, especially the Federal Reserve Bank. They might create new policies which can affect Ally's operations. I don't expect big changes, but if there is a shock in the economy, then all banks will be affected. Now let's talk about investing in Ally. The stock price is down more than 40% from its peak. They pay a nice dividend of about 4% and the PE ratio is about 6. When you want to value banking companies, you can't use discounted cash flow. There is another way, and that is price to tangible book value. When the ratio is below 1, the stock price is not overvalued, and when it's above 1, the stock price is overvalued. Now the tangible book value is about 32, as the liabilities have increased, but if they normalize, the tangible book value will be about 48. In addition, if they expand their business, as you've seen they have room to grow, then they can increase the book value, and the value will be even higher. Moreover, they might do new buybacks, which can give you an even higher return. Ally used 1.6 billion in 2022 for buybacks, and almost 2 billion in 2021. If they continue to do at least 1 billion in buybacks a year, then your return will be over 10% per year, as the market cap is about 9 billion. Plus, you get a dividend of about 4% a year at the current price. They said they'll stop doing buybacks in 2023, as they expect a mild recession. But then they'll do buybacks again and increase the dividend. So you can get a nice return on buybacks of about 10%, 4% in dividends, plus growth in their earnings, as they expand their business into other types of loans. And that's why Warren, or his partners, bought almost 10% of the company. I can say that this is a safe investment, as the Fed keeps increasing interest rates, and other problems may arise. But as the tangible book value is now about 42, and if you can apply a margin of safety to wait for another decline, then you might double your money in the next 5 years. Even at the current price, you might double your money if the economy improves. The problem is, I currently don't see their mode. There are other banks that can offer the same services. The management seems honest, they focus on risk, and there are opportunities to grow. So it's up to you whether you like this investment or not. And tell me in the comments, where do you see this business in the next 10 years? And if you find value in this video, please give a like and subscribe to see more videos like this because I want you to succeed.